Hi, in this video I want to talk about why average market returns are total b****. Let's get started. Okay, here you can see the historical data of the S&P 500 since 1871 without dividends. So the average market return was more than 6%. We of course expect some variation year to year, however. Almost everyone assumes that if one is so-called long-term investor, then in the long run they will achieve this average market return if invested in a low-fee index fund. And this is very far from the truth. Let me explain why. We need to start from the basics, and we will start by explaining the difference between the arithmetic mean and the geometric mean. Just scroll the video to the timecode you can see now on your screen if you already know what they are and what the difference between them is. The arithmetic mean is calculated by summing all the values and dividing by the number of the values. For example, 2 plus 8 plus 32 divided by 3 equal 14. The geometric mean is the nth root of the product of the values. For example, take the cubic root of 2 multiplied by 8 multiplied by 32 will be cubic root from 212 equal 8. Okay, so actually the math is not that important, you can easily Google it, but the intuition behind it is crucial. Let's have a look at that. Imagine you're investing $100 in the stock market. On year 1, your investment doubles, reaching 200. On year 2, your investment grows by 50% and bringing it to the 300. And on the year 3, your investment doesn't change at all. What's your average annual growth rate then? Using the arithmetic mean, 2 plus 1.5 plus 1 dividing by 3 equal 1.5, which corresponds to 50% growth per year. However, if you actually experience 50% growth each year, your investment would grow to $337. The geometric mean gives us something like 1.44 or approximately 44% growth per year. And let's just check the equation. 100 multiplied by 1.4 3 times, which would be around 300, which actually verifies our calculation. First and foremost, average returns are almost always complete nonsense. Even worse, one could easily come up with an example where despite a positive average return, you're actually losing money. Consider this example. Imagine you invest 100 in a volatile stock. On year 1, the stock loses 50% of its value, so your 100 becomes 50. The stock gains 60% on the second year, so your 50 becomes now 80. The average return will be minus 50 plus 60, dividing by 2, 5%. Positive, even if you lost money in reality. But the geometric mean gives you around 0.9. which represent about 10% decline, and as you can see, even with a positive average return over 2 years, you can lose money. Also note that the geometric means actually provide the correct measure. In finance, the geometric mean is known as the CAGR, compound annual growth rate. You can now forget the other math terms and just remember this one. So when you see average in the context of investments, just forget it and look for the CAGR instead. Okay, the brief math digression is over. Let's move on to the main topic of this video. Since we already know that the average returns are nonsense and that the geometric mean is our friend, we will just use the CAGR and we are done. End of the video, right? Wrong. The main reason for this is the investment horizon. In the best case scenario, your investment horizon would be your entire lifespan. But this is highly unlikely. We are not referring to the wealthy people here, we will discuss them separately later, but rather to ordinary folks who didn't inherit a huge stock portfolio from their parents and therefore have to start from the scratch. In that case, your youth doesn't contribute to your investment horizon, and if you consider why people invest, and it's usually for retirement, the years during the retirement also doesn't contribute towards the investment horizon, so how many years are left? In the best case, I would say around 40 years. In reality, very often 25 to 30 years is the long-term investment horizon you can realistically expect. But it gets worse. Usually, during a financial downturn, people tend to tap into their investment savings because they need to pay the bills after being laid off. A 2023 survey showed that more than 1/3 of workers have taken a loan, made an early withdrawal, or taken hardship withdrawal from their 401k or similar plan or IRA. But more on that later. Let's come back to our investment horizon. Since market returns, whether average or CAGR, are calculated based on more than 100 years of historical data, you would never actually obtain the market return. To experience the full market returns, you would have to enter the market in the first year the New York Stock Exchange was created and hold your position for 200 years. That's not possible, and this is why exactly you have your own personal entry and exit points, resulting in a personal return rate that will most likely be far from the market returns. But if market returns tell us nothing, how can we estimate our stock returns? There's no easy way to do that, but we will try to gain an intuition about how one should act to achieve good returns with a high probability. Markets are absolutely unpredictable, nobody knows, even if they think they do, where prices will go. But can we then treat the markets as completely random? Unfortunately not. They are unpredictable, but not entirely random. If the markets were random, we could simply use a random number generator. And if it produced, say, 2000% market growth next year, that would be equivalent to getting 2% for the same period. In reality, of course, we would immediately reject the 2000% figure as a total nonsense and assign a high probability to the 2% return prediction. Let's have a look at historical inflation-adjusted returns of the S&P 500, also known as the real returns, since 1871. Immediately, you can see the difference between the average returns and the geometric mean, so-called CAGR returns, and how real returns are much lower than the average ones. Here is a return distribution histogram. Imagine it is a series of buckets where we place our yearly market growth results. On the left are the buckets for the bad years when markets are down, and on the right buckets for the years when markets soared. As you can see, this distribution is roughly normal, with markets generally gravitating towards either a small decline, less than 10%, or a modest growth, around 20%. Now we are going to take these buckets and the values within them and use them to predict future returns. Okay, hold on with me. It will become very intuitive very soon. So, we want to test an investment strategy, or rather an investment approach. We know the past performance doesn't guarantee future results, so we can't rely solely on it. Additionally, we cannot generate completely random numbers because market returns are not random. They comply with the internal logic of the financial market, which I suppose nobody truly understands. However, what we can actually do is create pseudo-random values based on past market performance. So instead of generating completely random values, we will take 140 years of past market returns and then shuffle them. This is an important point to understand. We're now generating different random scenarios for the future returns, but we will restrict our randomizer only to the values that are equal to the past market returns. By doing so, we will, to a certain extent, inherit information about the hidden rules of the market that drives our returns, and at the same time be able to stress test our investment approach. This is very different from the backtesting strategy. Backtesting involves taking an investment strategy, running it against historical data, and seeing how it would perform. Instead, we would create a range of hundreds of different future outcomes based on historical market returns. Let's for starters take the last 10 years and their returns. So now we have generated one possible future outcome for our portfolio. For simplicity, our investment would be one-time $100 investment in the first year of the simulation. Let's generate another possibility. This is a different potential trajectory for how our portfolio could develop in the future. And here you can see yet another outcome. Are you getting it? We need to generate a decent number of equally probable future outcomes to assess our position. Here you can see 10 of those simulations at the same time. It can already be easily spotted that we are observing a range of future outcomes. You can read this chart as follows. After 10 years, my final portfolio value is uncertain, but it falls within the interval between $200 and $300. This is just an example, because this graph uses only the past 10 years and has generated only 10 outcomes. But what if we use all the data from the last 150 years of the stock market and run our simulation 200 times for an, let's say, average long-term investor horizon of 25 years? Let's do it. Ta-da! Okay, don't run away. This is the space of possible outcomes for our 100 investment in a real life over 25-year horizon. It is a range in which we could end up with as little as $20 or as high as $1,700. Pretty big range, isn't it? Because, life sucks and it's very unpredictable, but even these results can provide us with many insights. First, I need to explain the percentile values and the red, orange, green and green lines. So the percentiles are like finishing positions in a race of 100 possible market outcomes. 5% percentile means that you finish fifth from the bottom. It's just a straight worst case scenario. 25% percentile means that you beat 25% of outcomes. Let's say it's below average performance. 75% percentile, you actually outperform 75% of possibilities. This is very solid returns. And 95% percentile, it's just like you won the race. It's exceptional. These help investors understand the range of possible results rather than just the average, showing both the potential upside and downside of investments over time. First, take a look at the average and median final results, and even more importantly, the CAGR of the final value. Our median compound inflation-adjusted growth is around 2%. This is so-called the real CAGR. Plus, you need to add dividends in mind. I don't have precise numbers, but it will add approximately another, let's say, 2% of growth. So it's like 4% together. There's a very high chance that your portfolio will grow at approximately a 4% real compound rate, and this is a really, really good number. You can use this rate to evaluate your portfolio intuitively by taking your initial investment, let's say $100, and increasing it by 4% repeatedly over 25 periods, resulting in the final value of your investment. In contrast, if you assume the widely advertised 12% annual return of the S&P 500 and perform the same calculation, the final number would likely represent what would you have gotten if you had invested at the most fortunate time in market history, rather than a typical average return. And finally, postscriptum, so to say, something everyone already knows, but the chart shows it very clear. Why staying in the market long-term is so important. Check this out. We can run simulations after simulations hundreds of times and still obtain very consistent results. But what is more interesting is that if we change the investment horizon to 5 years, then run a few simulations and observe the lowest and the highest results, and next increase the investment horizon by 5 years, you will notice that while the low remains the same, the high grows dramatically. These low and high values represent the probabilities of terrible market performance and excellent performance respectively. We don't know for sure what kind of performance the markets will have, but we know that our worst-case downside is ending up with $50, losing around half of our investment. Most importantly, this remains true regardless of the time spent in the market. In contrast, our upside grows over the years. Every 5 years of waiting almost doubles the amount we could achieve in the best-case scenario. What does this mean? You can view the investment as taking the risk of losing half of your money for an opportunity to potentially reap approximately 4 times the initial capital if invested for 10 years, 6 times for 15 years, and 10 times for 20 years. By entering the market, you take on the risk of losing money. However, by staying in the market, you don't decrease your risk of loss. Instead, you increase the potential reward in a lucky scenario. That's why it's so important to stay in the market, whatever it takes, for as long as possible. One should be obsessed with how long one stays in the market, rather than focusing solely on how much return currently has in portfolio. The common view on rainy day fund is to cover 6 months of expenses. However, there are many events that can hit you harder than just 6 months worth of expenses. Imagine being unemployed for an entire year, which does happen, or facing a huge medical bill. Therefore, you should consider having a larger cash pile, maybe up to 2 years of your income. You might argue that this is a huge inefficiency, but as we saw in the chart, preventing yourself from tapping into your investments is one of the most crucial steps in investing. On the other hand, you should understand that by investing money, you are paying an opportunity cost, putting your money into investments instead of using it in any other way. You are not going to become rich simply by investing in a stock market index. Our main opportunities to become wealthier lies well beyond the stock market. By having a sizable cash pile, you open yourself to those one-time opportunities when life throws them your way, like investing in a friend's startup or buying valuable property during a huge market downturn. Okay, I think that's it. Thanks for watching. Please hit like and subscribe, and see you in the next one.